Today, we want to talk about one of the key mistakes that we see first time property investors or even second time property investors and home buyers. Often, what they do is they just think about property first and then finance later. And they think that the finance is the easy part and they really need to figure out the property side of things. And Mona, my view is that if it's been your approach so far, that's really not your fault because that is how the industry operates and finance is treated like a commodity.
That's right. So it's been treated as a commodity. And for that reason, most investors, a mistake they make is that they don't have an upfront strategy or plan as to how they're going to be accumulating investment properties. So it's not an overnight journey. So it depends on the lending climate you're in at any particular point in time. But you need to have your initial finance set up correctly so that you are set up to build that property portfolio. And that may span over a number of years. Again, it's not overnight. So you tick it off over a period of time, but you get your finance basics right. So you're set up to expand down the track. Yeah, effectively, like we've had clients who started with their first homes or they already had a home and then they've gone on to expand onto multiple investment properties. That's only been possible by being deliberate with the finance setup.
That is right. And often we come across people, right? They would reach out to us and they would be possibly a homeowner right now, just owner occupied property, or maybe just own one investment property. What they often do is they build up their savings in their offset account, but there's a few things actually that they do wrong. The first is they pull out any savings that they've built in their offset account and that they put that as a deposit towards their next investment property. And what that means is they miss out on any tax savings. Of course, seek tax advice because we are not tax advisors, but most people pull out cash and go put a deposit on an investment property. The result that happens is they end up taking much longer to pay off their owner occupied properties. As a result, they lose tax savings on that investment property they've just bought. And by not having that finance set up correctly or having the planning done, they have no risk mitigation in place. Another thing people do is they go cross collateralize their property. So they just go to their bank or their broker and they end up tying multiple properties together. It is high risk. They run into high risk structures because they haven't planned that upfront. And the issue actually is not known when you have done the purchase. It really becomes a problem when you need it to not be a problem when you're selling the property or you're refinancing, you're trying to tap into the equity. And as a result, you're not able to move to multiple properties because you're just stuck with two. And we've had clients actually come to us to uncross their properties because they had a friend who owned an investment property and they sold it. And at settlement, the bank took all the profit because they had another property linked to it. So any profits they were looking to see that it's paid the taxman or they paid the bank. They're really gone backwards. And that's not why you're investing.
Yeah. And I guess we've had clients where we have fixed their bad structures where they were cross collateralized and it was quite an intense process in splitting the property. So thinking about these clients, they actually, by cross collateralizing, actually the bank cross collateralized them because there was no plan done upfront. They ended up paying so much more lenders' mortgage insurance as a result because of the overall lending that they had. And then we helped them separate it out, which meant that down the track, they were able to sell that one property that was left with their previous bank and they were able to keep their home. If we hadn't done that, then in a market which was slow, they would have really struggled because they would have sold that one property and their second property might have been worth a bit less. Then how would they have made up for the difference? Because the bank wants to keep the loan to value ratio below a certain percentage. So that was the outcome of not planning and not being deliberate about the actions that these people needed to take. We were able to solve it for them, but why get into that situation? And as Sana said, it's only really a problem when you come to doing something into the future. So you need to plan upfront to avoid any pitfalls down the track. And another one that we find is people selecting incorrect payment types. For the purpose of the loan, they select an incorrect payment type. So that means that they end up taking much longer to pay off their own home, which is their non-tax deductible debt. They're paying more interest on their non-tax deductible loan over the life of the loan. So you need to really weigh up what is the repayment type, what are my future goals, how does it actually fit into my future plans, how does it actually help me get ahead?
Or would I end up paying a lot more interest on my owner occupied property where I have no tax benefit? Of course, you need to seek tax advice on that, but there is a right way of setting up your loan depending on the security type or the purpose of that property and the purpose of that loan.
That's exactly right. So you need to be mindful of this because what if it could cut down years of your owner occupied mortgage? reach doing it the right way. And then one that we come across quite often is selecting the wrong lender without knowing why you're actually choosing this lender. It's not about the refinance rebates. It's not all about the lowest interest rates. It's about how does it enable you to move forward. Sure, we need to take all those things into account and weigh it all up and rank it in order of what's important to you and make the choice and say, well, if I choose XYZ bank, this is how it fits into my big picture. This is how it will help enable me to move forward down the track.
I'd like to add, these things do evolve over time. So you might start with a lender, you might have, say, paid LMI. Down the track, you have the property grows in value and you evaluate. You keep reevaluating on where the strategy fits. There is an order of lenders to go in, but also there's an order of what suits you at a certain point in time. And lending policies keep changing, lending calculators keep changing. So you have to go with the times where you are and make decisions with where you are, but make sure you are keeping your options open and have the flexibility to continue moving forward.
And we've had clients, right, who we say assisted around about 5 or 6 years ago, and we had to place them with a particular lender that suited their circumstances at that point in time. And since then, we've been able to restructure those loans, and they've been able to expand onto the next property and the one after that. So it's over a period of time. It's not set and forget. And often people treat lending as set and forget, but you need to keep reassessing as to how it's enabling you to move forward. So instead of obviously all these mistakes or pitfalls, what you need to do is think of finance as a vehicle, really. And if you don't have the right finance setup at the start, you may not be able to access the right finance as and when needed. You may not be able to reach your potential or maximize what you're able to do with your resources. And as a result, you can't really build a portfolio and not be able to reach that financial freedom, security, stability that you are striving for. And often it's too late when people realize. So if you are in the infancy of your journey or you're starting out, then you need to just have that strategy there and know what direction you're heading into.
Unfortunately, people think just about the now and not the future, what they want to do. So your current situation doesn't have to be the whole script or the whole story that you're going to follow. If you're only able to do one purchase today, that doesn't mean you won't be able to do more in the future. So make sure you're thinking that through on the front end. People think it's easier to just do whatever right now because we don't know if we'll be able to buy more properties or where we would be. But if you keep those options open and think about the future, you would be better placed to take better actions down the track or say, look at this analogy. You're on a highway and you're driving at night. You can only see the next couple of 100 meters, right? And that's the furthest you could go, but you have a GPS around as to where you want to go. And that's really important. As Mona said earlier, we have clients who started with just their home. And because of how their loan was set up and the reviews and the evolving strategy over the years, they've gone from one property to multiple properties. Like we have clients started with just one, bought 2, 5, 8 investment properties over a period of time. So you do need to do things a little bit differently, right?
That's right. So what you need to do if you're starting out, or even if you have started already and it's not too late to reassess it, you need to ensure your finance is set up upfront so you can pay off your home fast, save on tax, minimize risk. So as a result, you'll be able to maximize what you can actually do and what's actually financially possible for you to do so you can achieve your financial freedom, security, control, and stability in future.
Well,
and also
that's what we do, right, with our clients to move from one property to the next and the one after that. Avoiding pitfalls of bad setup is what's more important in this journey. So it is not really about the property, right, guys? We've just told you how finance disables people from expanding their portfolio. Yes, property plays a part, but if you haven't thought of finance, then your portfolio is over before it's even begun from there on.
That's right. To play the long game, right? Don't just look at today, what you have, but look at what you'd like to do down the track and really look at your goals. Actually, does it actually help you achieve your goals? How does it fit into your bigger picture? Not the bank's bigger picture, but your bigger picture, effectively.
So guys, if you're looking to do it the right way and you're planning to take action within the next 90 days, skip the line and book a time with the team about how you can start or grow your property portfolio. Sirat will be popping in the link in the comments at meetme.so/property twins. And we're looking forward to you doing the right way from the start.
And I guess if anybody's got any questions on what we've discussed today, just feel free to pop into the comments and we'll revert back to you on any responses.
Thanks, guys.
Thank
Catch
you
later.
Bye.
Bye.
Bye.